Usually, when you study the collapse of a massive corporate enterprise, you are observing a long, visible decay. You watch this slow erosion of market share, a gradual bleeding of capital. It is a multi-year decline that, frankly, every analyst, shareholder, and competitor can see coming from miles away.
Right. That is the standard pathology of corporate failure. We are accustomed to seeing structural cracks widen over years, which, allows stakeholders ample opportunity to observe the deterioration and attempt course corrections. It is usually a slow motion unraveling.
But when you step into the timeline of the 2008 global financial crisis, you witness something entirely different. We are looking at a corporate autopsy that defies every conventional model of how a business dies. It wasn't a slow leak, it was a high-speed, catastrophic mechanical failure.
Exactly. It was the complete dissolution of trust and liquidity within a time frame so terrifyingly compressed, it literally forced regulators and central bankers to rewrite the fundamental textbooks on systemic risk.
Welcome to Peak to Dust, the documentary audio series that investigates the rise and sudden evaporation of historical giants. In this deep dive, there will be no casual commentary. Our objective for you, the listener, is to conduct a prestige forensic financial investigation into an 85-year-old Wall Street investment banking titan, which is Bear Stearns.
Yes, we are going to dissect in highly granular detail how a firm that survived the Great Depression, the 1987 stock market crash, and the economic fallout of September 11th simply ceased to exist in a mere 72 hours.
And to conduct this autopsy properly, we are relying strictly on the documentary evidence. We're not dealing in rumor or retrospective opinion. We are analyzing a comprehensive stack of source material today.
That is right. You will hear us cite the official Securities and Exchange Commission Form 10-K from 2006 and 2007. We also have recovered internal Bear Stearns asset management presentations, internal corporate memos dating back to 1987, the highly critical Oliver Wyman risk management report from February 2008, and official regulatory findings from the aftermath of the crisis.
We are building our timeline exclusively from those records. And as we navigate this timeline, we need to establish a firm parameter for you right at the outset. Because this investigation deals with the mechanics of the financial system, we will necessarily be covering interventions by the United States government and the Federal Reserve.
Yes, and our analysis will remain strictly impartial. We are here to report only the factual timeline and the precise mechanics of those federal actions. We are not endorsing, nor are we condemning, any political or economic ideology regarding government bailouts, taxpayer exposure, or monetary policy.
Right. Our focus is purely forensic. The data, the balance sheets, and the chronological execution of events that led to the firm's demise. So to understand the velocity of the fall, we first have to measure the sheer height of the peak.
We do. We need to look at the architecture of this financial powerhouse, stretching from 2006 into early 2007.
Because if you look at the official 2006 financial metrics, Bear Stearns wasn't just surviving. I mean, they were dominating.
Dominating is the right word. The 2006 SEC filings paint a picture of an institution operating at the absolute zenith of its power. For the fiscal year ending November 30, 2006, Bear Stearns posted a record net income of $2.054 billion.
$2 billion in net income. Just to put that figure into perspective for you, that net income was generated from $9.227 billion in net revenues. And that is revenue after subtracting their interest expenses. It translated to a diluted earnings per share of $14.27.
And the efficiency metrics embedded in those filings were staggering. Their pre-tax profit margin for fiscal 2006 was 34.1%. The return on average common equity was 19.1%.
Which is incredible for a firm of that size.
It really is. By every conventional Wall Street metric, the firm was exceptionally profitable and seemingly bulletproof.
And the broader market rewarded that profitability very aggressively. On January 12, 2007, Bear Stearns shares closed at an all-time high of $171.51.
Pushing the firm's total market capitalization to a towering $20.24 billion. They were the fifth largest investment bank in the United States at that moment.
But their operational engine wasn't generalized, was it? They had a very specific machinery driving this dominance, particularly in their capital markets segment.
Yes, the capital markets segment was the absolute behemoth inside the firm. At the close of 2006, this segment alone generated $7.32 billion in net revenues. It operated as a single, highly integrated unit, providing sales, trading, and origination for various fixed income, equity, and advisory products.
Right.
And while their institutional equities division brought in a very respectable $1.96 billion, the true Leviathan was the fixed income division. Fixed income generated $4.19 billion in net revenues in 2006 alone.
And we have to ask, what exactly was driving that fixed income dominance? Because it wasn't traditional corporate bonds or government treasuries, was it?
No, not at all. It was driven by unprecedented volume in the origination and secondary trading of structured finance products, specifically mortgage-backed securities, asset-backed securities, and collateralized debt obligations. Bear Stearns was a dominant, pioneering force in the global securitization pipeline.
But before we pull apart the mechanics of that securitization pipeline, we have to look at the culture that built it. Because the architecture of Bear Stearns was not just mathematical, it was intensely psychological.
It was a very unique environment.
Very unique. This was not a traditional aristocratic white shoe Wall Street firm. To understand how they operated, you have to read the internal memos of former CEO Alan Ace Greenberg.
The source material provides a fascinating window into that.
It really does. It was a culture obsessively focused on cost control. I want to read directly from a memo dated October 26, 1988. It reads, "Electricity is not free. This will come as a complete surprise to 98% of the people who work at Bear Stearns. Why am I so sure? I walk the halls after 5:30 p.m. and I see a blazing array of unoccupied offices."
It is a remarkable piece of corporate history to analyze. There's another memo from August 1987 that announces a freeze on what Greenberg explicitly terms carelessness, prohibiting what he called slop.
Slop. That's the exact word he used.
Yes. He wrote, "We probably throw away millions every year with stupidities and slop. No business is strong enough to withstand constant stupidity." He was literally micromanaging the firm's expenses down to the paper clips and the light switches.
And Greenberg also dictated a very unusual hiring philosophy for Wall Street. He didn't want the polished Ivy League graduates, did he?
No, he openly stated a preference for hiring individuals with what he called PSD degrees. In his definition, PSD stood for individuals who were poor, smart, and had a deep desire to become rich.
Which is a complete departure from the norm.
Entirely. This mandate created a fiercely independent, aggressive, essentially blue-collar trading culture on the floor. It was a stark contrast to the pedigree heavily favored by competitors like Goldman Sachs or Morgan Stanley. Bear Stearns wanted scrappy, intensely money-motivated individuals who would fight for every single basis point of profit.
And they structurally incentivized that aggression, too. And approximately 1/3, 33% of the entire firm was owned by its employees across all ranks.
That alignment of interest is crucial to our analysis here. When employees own 1/3 of the equity, they are theoretically highly motivated to think and act like owners.
Because it's their own money on the line.
Exactly. The logic is that they will ruthlessly safeguard the firm's capital because it is quite literally their own wealth. Greenberg actually wrote in a 1987 memo, "We own 60% of this place. Let's keep it sound and make it grow. Our compensation is based on the firm's profitability." Now, that percentage shifted down to roughly 33% by 2006, but the core principle remained intact. They paid for performance, aligning management tightly with shareholders.
But this introduces a massive structural paradox that we need to unpack. If I'm looking at a firm that micromanages its balance sheet down to the cost of office electricity and where the employees own 1/3 of the stock, how do we reconcile that hypervigilance with the massive existential risk they were simultaneously accumulating on their trading desks?
It is the core contradiction of the firm.
It feels like we are looking at a ship captain, meticulously counting the life vests, making sure the lights in the galley are turned off to save fuel, while completely ignoring a massive hole below the waterline. How does a culture so obsessed with efficiency miss a risk that could wipe out the entire company?
That is the defining question of this entire investigation. And the answer lies in the specific mechanics of the risk they were taking. The cost control culture focused on operational expenses. Things like electricity, travel, supplies. Those are highly visible, immediately measurable, and easy to understand.
Right, you can see a light left on.
Precisely. But the macro-level risk they were accumulating was embedded deep within complex mathematical models and off-balance sheet structures. It was a risk that remained invisible to the naked eye until the exact moment it began to fail.
So let's pull back the curtain on that invisible risk. We need to dissect the machinery of their dominance, which brings us to their securitization pipeline and their application of extreme leverage. To start, alongside their capital markets division, Bear Stearns operated an incredibly lucrative engine known as Global Clearing Services. What was the function of this segment?
The Global Clearing Services segment essentially provided the essential plumbing for the shadow banking system. They provided execution, clearing, margin lending, and securities borrowing to facilitate customer short sales for clients worldwide.
And who are these clients?
Their prime brokerage clients were the heavyweights of the financial world. We are talking about hedge funds, money managers, and professional arbitrageurs.
And the scale of this was just massive, according to the records.
Truly massive. By February 2007, Bear Stearns held a staggering $298 billion in equity in global clearing services client accounts. They were the central nervous system for a vast network of professional investors.
Generating huge returns.
Yes, this segment alone generated $1.08 billion in net revenues in 2006, largely from net interest revenues on customer margin balances. They were financing the trades of the most aggressive funds in the world.
But the true engine of their own profitability, and ultimately the instrument of their destruction, was the securitization pipeline. Bear Stearns was a titan in the creation and packaging of mortgage-backed securities, or MBS, and collateralized debt obligations, or CDOs. We need to clearly explain the step-by-step mechanics of how this factory actually functioned, because this is where the toxic risk was manufactured.
It operated as a vertically integrated supply chain. Bear Stearns owned a subsidiary called EMC Mortgage Corporation, which was a HUD-approved lender headquartered in Texas. EMC's role was to aggressively purchase loan portfolios from unaffiliated mortgage lenders across the country.
And what kind of loans were they buying?
Importantly, a massive volume of these were subprime adjustable rate mortgages. These were loans given to borrowers with poor credit histories.
So they are buying up thousands of these individual risky home loans. What happens next?
They pool them together. EMC would take thousands of these subprime mortgages and bundle them into a single massive pool. Then the securitization factory goes to work. They slice that pool of mortgages into different risk categories, known as tranches, to create a mortgage-backed security.
Let's use an analogy here for you, the listener, to visualize how this tranching works. Imagine the cash flowing in from thousands of homeowners paying their mortgages every month as a waterfall. The tranches are like buckets positioned at different levels beneath that waterfall.
That is a perfect visualization. The senior tranche is the bucket at the very top. It gets filled with cash first.
Yeah.
Because of the first to be paid and the last to take a loss if homeowners default, the credit rating agencies like Moody's and Standard & Poor's would award this top tranche a AAA rating.
Meaning it was considered as safe as a U.S. Treasury bond.
Exactly. Completely risk-free in the eyes of the market.
Right, but what about the buckets underneath?
The middle buckets, the mezzanine tranches, only catch the water that overflows from the top bucket. They take the first hits if borrowers default, so they receive lower ratings like A or BBB, but they offer a higher yield to investors to compensate for that risk.
And at the very bottom?
At the very bottom is the equity tranche. That is the bucket that often catches nothing if the stream dries up. It absorbs the very first losses and is often unrated or rated as junk.
But Wall Street's demand for high-yielding assets was insatiable at this time. They didn't stop at just creating mortgage-backed securities. When investors wanted more, Bear Stearns and others took the lower-rated, riskier mezzanine tranches, the middle buckets from dozens of different MBS pools, and packaged them together to create an entirely new security, which is the collateralized debt obligation.
Yes. They essentially ran the raw, riskier material through the securitization factory a second time.
And this is where the alchemy of financial modeling created a fatal illusion, right?
Precisely. Through complex diversification models utilized by the rating agencies, the senior tranches of these newly created CDOs were somehow awarded AAA ratings.
Wait, let's slow down on that because it's vital. You are telling me they took a bunch of BBB-rated bonds composed of subprime mortgages that were inherently risky, put them into a new pool, and suddenly the top layer of that new pool was magically rated AAA. How is that mathematically justifiable?
Well, the rating agencies relied on statistical models based on historical correlations. The primary assumption was geographical diversification. The models assumed that subprime borrowers in Florida, Nevada, and California would not all default on their mortgages at the exact same time.
A localized housing downturn versus a national one.
Right. Therefore, pooling them together supposedly diversified the risk enough to warrant a AAA rating on the senior tranche of the new CDO.
And Bear Stearns didn't just sell these CDOs to clients, they heavily invested in them themselves.
They did. We have the recovered internal presentations from Bear Stearns Asset Management, or BSAM. The presentation explicitly outlines their internal strategy. Their goal was to generate consistent cash and carry returns by buying and holding what they believe were ultra-safe AAA and AA structured finance securities.
So they genuinely believed the models.
They believe rating agencies. They thought they were holding incredibly safe assets that just happened to yield a premium over traditional corporate bonds.
But to buy those assets and juice the returns, they utilized a mathematical architecture of extreme leverage. Let's perform the forensic math on the leverage ratios documented in the firm's 10K and subsequent risk reports, because this is where the structural vulnerability is completely exposed.
And numbers are stark.
They are. By the end of fiscal 2007, Bear Stearns reported roughly $11.8 billion in stockholders' equity.
Yes, $11.8 billion in equity. But that equity was supporting approximately $395 billion in total assets on their balance sheet.
Think about that for a second. If you have $395 billion in assets, but only $11.8 billion is actually your own money, the rest is borrowed. What is the precise leverage ratio there?
When you divide $395 billion by $11.8 billion, you are operating at a gross leverage ratio of roughly 33.5 to 1.
33.5 to 1.
Yes. However, the source documents show that when measured by tangible assets to tangible common equity on a monthly average basis, their leverage was actually fluctuating closer to 42 to 1.
Okay, let's translate what 42 to 1 leverage actually means for a firm's survival. If I'm leveraged 42 to 1, how much does the value of my $395 billion asset portfolio have to drop before my $11.8 billion in equity is completely wiped out?
It creates a razor-thin margin for error. At 35 to 1 leverage, a mere 2.86% decline in the value of the firm's assets completely obliterates its entire equity base.
Just 2.86%.
Yes, and at 42 to 1, a drop of just 2.38% renders the firm technically insolvent.
That is mathematically terrifying. A drop of less than 3% wipes out an 85-year-old institution. This extreme leverage, combined with their heavy reliance on supposedly safe AAA-rated CDOs, created a machine that looked flawless on paper. But it was engineered with a catastrophic, fatal assumption. It functioned flawlessly, only provided that nationwide housing prices never fell.
Correct. The entire architecture rested on the underlying cash flows from subprime homebuyers. If those cash flows dried up, the AAA ratings would be exposed as meaningless, the value of the CDOs would plummet, and the 35 to 1 leverage would amplify a small drop in asset value into total annihilation.
And compounding this mathematical fragility was the funding mismatch. Bear Stearns was buying long-term, highly illiquid assets, 30-year mortgages packaged into complex CDOs. But how were they paying for them?
They were funding these long-term assets with short-term liabilities. By 2007, a massive portion of their balance sheet was funded through the overnight repurchase or repo market.
Meaning they were borrowing daily.
They were literally borrowing tens of billions of dollars every single night to hold assets that could take years to mature or sell.
So we have an intensely micromanaged culture sitting on top of a securitization factory, generating record profits by applying 35 to 1 leverage to off-balance sheet, subprime-backed CDOs, and funding the entire operation on a day-to-day basis. The stage is perfectly set.
It was a highly combustible scenario.
Which means we need to look at the exact moment this machine began to fracture. The unraveling didn't start at the parent company level. It started deep within their asset management division.
It began in the summer of 2007, serving as the canary in the coal mine for the entire global financial system. The unraveling originates with a portfolio manager named Ralph Schiaffi and two specific internal hedge funds he managed under the Bear Stearns asset management umbrella.
Let's trace the collapse of these funds. The first was the Bear Stearns High-Grade Structured Credit Strategies Fund, which launched in 2003.
Yes. And for years, the high-grade fund was a stellar performer. It generated steady, consistent returns of 1 to 1.5% a month, with essentially no drawdowns. It attracted massive institutional capital.
Success breeds expansion on Wall Street.
Exactly. Because of this success, BSAM launched a sister fund in August 2006 called the Enhanced Leverage Fund, raising an initial $642 million. Schiaffi himself described this new fund in marketing materials as simply a levered version of the high-grade fund.
The documentary evidence we are examining exposes a severe deception regarding the true nature of the risk inside these funds. The marketing materials provided to investors claim that the funds had very limited exposure to the subprime market, only around 6% to 8%.
That was the marketed claim. However, SEC investigations and subsequent court documents revealed a radically different reality. An estimated 60% of the underlying collateral in these funds was comprised of subprime mortgages.
60%, not 6%.
Right. The exposure was simply hidden within the complex architecture of those AAA-rated CDO structures we just analyzed. The funds thought they were buying safety, but they were buying concentrated subprime risk.
And the leverage applied within these specific hedge funds was even more aggressive than the parent company.
It was astronomical leverage, layered upon leverage. Let's look at the internal structure of the funds themselves. The high-grade fund reported $8.6 billion in total assets, but it only held $900 million in actual investor capital. The remaining $7.7 billion was borrowed money.
And the enhanced leverage fund.
It was even more precarious. The enhanced leverage fund had $900 million in investor capital pitted against $8.5 billion in borrowed funds.
Wow.
That is an internal leverage ratio of nearly 10 to 1 inside the fund itself. So you have highly leveraged investor capital being used to purchase highly leveraged CDO tranches, which were themselves built on the backs of highly leveraged subprime home buyers.
It's a house of cards stacked on a fault line. And as 2007 progressed, the foundational layer, the subprime borrower, began to default. Let's trace the chronological timeline of this collapse, what became known on Wall Street as the Summer of Seizures. It starts with deception in the spring.
In April 2007, the subprime market was clearly deteriorating, but the fund's management misrepresented the condition of their portfolios. They projected essentially flat returns for the month, attempting to mask the damage and keep investors from withdrawing their capital. But, mathematical realities cannot be hidden by models indefinitely.
No, because eventually your lenders demand proof that your assets are worth what you claim. And that brings us to June 7, 2007.
By June 7, facing a flood of redemption requests from panicked investors and, more importantly, massive margin calls from their repo lenders, Bear Stearns Asset Management officially froze all redemptions in the funds.
We need to explain the mechanism of a margin call for the listener, because this is the specific trigger that destroys leverage. How does a margin call actually work in this context?
Well, the Bear Stearns hedge funds had borrowed billions from other major Wall Street banks to buy these CDOs. When you borrow that kind of money, the lender requires collateral. The funds use the CDOs themselves as the collateral for the loans.
Okay, that makes sense.
But as subprime borrowers defaulted, the perceived value of those CDOs began to drop. The lending banks looked at the collateral and said, "This is no longer worth enough to secure our loan. You need to give us more cash or more assets to make up the difference." That demand is a margin call.
And the funds didn't have the cash.
Exactly. They unsuccessfully begged their lenders to convert their overnight repo obligations into 60-day term loans just to give them breathing room. When the lenders refused, the funds were forced to sell their assets into a panicked market to raise the cash.
Which is the worst possible time to sell.
It is. Selling toxic assets into a distressed market only drives the market prices down further, which in turn triggers even more margin calls from other lenders. It is a textbook, inescapable vicious cycle.
The parent company, Bear Stearns, attempted an internal bailout. They pledged a collateralized loan of $3.2 billion to try and arrest the deteriorating value of the high-grade fund, hoping to project stability. But the critical turning point, the moment the systemic rot became entirely visible to the global financial system, occurred on June 20, 2007. This is the day the illusion shattered completely.
On June 20, Merrill Lynch, which was acting as one of the major repo creditors to the funds, ran out of patience. They seized $850 million of the fund's underlying CDO collateral and attempted to liquidate it to recoup their money. They held an auction.
And what happened at that auction?
Out of the $850 million in supposedly highly rated assets on offer, Merrill Lynch could only find buyers for $100 million.
$100 million out of $850.
Yes. The major banks and institutional investors were simply not prepared to bid over 85% of face value for these CDOs, even though they were ostensibly rated A or better by the agencies.
I want you to think about what that means for a moment. If you take a certified, appraised gold bar to a pawn shop, and the broker takes one look at it, tells you it's just painted lead, and refuses to lend you a single dollar against it, what happens to your perception of your own wealth? That failed Merrill Lynch auction provided the market with the one thing everyone was terrified of: actual, undeniable price discovery on subprime CDOs.
It was a devastating revelation. It confirmed empirically that the models were fundamentally broken, and the assets sitting on the balance sheets of every major bank in the world were vastly overvalued. The realization that there was zero liquidity for these assets sparked a massive chain reaction of write-downs across the global financial system.
And for the two Bear Stearns hedge funds, it was a death sentence. By July 31st, 2007, the run on the funds and the total collapse of their asset markets forced both funds to file for Chapter 15 bankruptcy protection in the Cayman Islands.
The fallout from this was severe and multifaceted. Ralph Cioffi and his co-manager Matt Tannen were later federally indicted for misleading their investors.
Yeah.
Though to maintain factual accuracy, it must be noted they were eventually acquitted of the criminal charges in 2009. But from a corporate standpoint, the reputational damage to Bear Stearns was immediate and irreparable.
The market no longer viewed Bear Stearns as the scrappy, efficient, hyper-profitable trading firm. They were now viewed as patient zero of the subprime contagion. The canary in the coal mine had died, and the toxic gas was now filling the main shaft of the parent company. The scrutiny shifted directly from the asset management division to the parent company's $395 billion balance sheet.
Which accelerates us into the fall of 2007. As the broader subprime crisis intensified, the credit rating agencies, heavily criticized for their initial failures, finally began to react. In November 2007, Standard & Poor's downgraded Bear Stearns' own mortgage-backed securities from AA to A.
And the financial impact of those downgrades hit the firm's bottom line with devastating force. Let's examine the Q4 2007 financial results, announced on December 20th, 2007. This was a historic, catastrophic moment for the firm. They reported their first ever quarterly loss in their 84-year history.
The numbers were brutal. Bear Stearns posted a net loss of $854 million for the quarter, equating to a loss of $6.90 per share.
Where exactly did that loss come from?
The specific balance sheet destruction detailed in the report is entirely centered on their securitization engine. The firm was forced to take $1.9 billion in net inventory write-downs, specifically on mortgage-related products and their pipeline of leveraged finance commitments.
Wiping out nearly all their gains.
Yes, their full-year net income for 2007 plummeted 89%, dropping down to just $233 million compared to the $2.05 billion they made the year prior.
The capital markets division, their former crown jewel, was decimated. Net revenues dropped 46% year over year. The fixed income division saw net revenues decrease by a staggering 84%. The machine had effectively stalled.
The leadership of the firm buckled under the immense pressure of these losses. CEO James Cain faced intense public criticism. Reports surfaced that he was playing bridge and participating in golf tournaments out of state while the firm's hedge funds collapsed over the summer. By January 2008, he was forced to step down as CEO.
And he was replaced by Alan Schwartz. But Schwartz was an investment banker by trade. He was a relationship guy, stepping into the CEO role of a highly complex trading firm right in the middle of a global liquidity crisis.
Schwartz attempted to project confidence and stability to the markets, but the documentary evidence reveals that the internal mechanics of the firm were severely compromised. We must dissect the illusion of their balance sheet management during this period, specifically a tactic known as Repo 105.
This is a crucial concept. How does a firm hide billions of dollars of debt from its own quarterly reports? Explain the mechanism of Repo 105.
Repo 105 was an aggressive accounting maneuver that exploited a loophole in Generally Accepted Accounting Principles, or GAAP. In a standard repo transaction, a bank borrows cash and gives securities as collateral with an agreement to buy them back. Normally, this is recorded on the balance sheet as a short-term financing arrangement. The debt stays on the books.
Right, because it's a loan. You haven't actually sold the asset.
Exactly. But under the Repo 105 loophole, if the value of the collateral given was at least 105% of the cash received, the accounting rules allowed the firm to classify the transaction not as a loan, but as a true sale.
So right before the quarter ends, Bear Stearns takes $25 billion of their illiquid assets, temporarily sells them to a counterparty in exchange for cash, and uses that cash to pay down their other debts. They take a snapshot of the balance sheet for the quarterly earnings report, showing significantly less debt and a much lower leverage ratio. And then, a few days after the new quarter begins, they legally buy all those toxic assets right back.
That is precisely how it functioned. It was temporary window dressing. By classifying these short-term borrowing transactions as sales, they artificially lowered their reported leverage. Without this maneuver, their public reported leverage in 2007 would have appeared substantially higher than the 35-to-1 ratio they disclosed.
It's essentially holding your stomach in while the doctor takes your x-ray, only exhale the moment you leave the room. But hiding the risk doesn't eliminate it. And if we look at the Oliver Wyman Risk Management Report, dated February 5, 2008, which is just weeks before the final collapse, the internal operational failures are laid entirely bare.
The Oliver Wyman Report is a damning piece of documentary evidence. This was an outside consultancy brought in to evaluate Bear Stearns' internal controls. Their conclusions were staggering for a financial institution of that size. The report noted that there was no formal framework for risk appetite at the executive level.
What does that actually mean in practice for a trading desk?
It means the firm's leadership had not clearly defined how much capital they were willing to lose in a worst-case scenario. Furthermore, the report cited a lack of coherent limit structures across trading desks, an underdeveloped process for strategic risk assessment, and a fundamental lack of institutional structure for enterprise-wide risk management.
So you have a firm holding $395 billion in highly complex, volatile, toxic assets, operating at 25-to-1 leverage, and the external auditors are telling them they don't even have a coherent limit structure on their trades. It's a catastrophic operational failure, which exposes the ultimate fatal vulnerability of Bear Stearns, which is their absolute reliance on overnight funding.
We must drill down into this funding mechanism because this is the specific artery that is severed in the final 72 hours. Bear Stearns was funding its massive portfolio of long-term, highly illiquid mortgage assets by borrowing between $50 billion and $70 billion in the overnight repo markets every single night.
Explain the brutal reality of this for the listener. How is an investment bank fundamentally different from the commercial bank where I keep my checking account?
Well, a traditional commercial bank funds its operations largely through your insured deposits checking and savings accounts.
Right.
That money is relatively stable and sticky. People rarely withdraw all their money at once.
Right.
An investment bank in 2008, however, funded its daily operations through the wholesale repo market. Every morning, Bear Stearns had to convince counterparties, like money market funds and other banks, to lend them tens of billions of dollars, secured by the assets on their balance sheet. And the next morning, they had to pay it back and borrow it all over again.
And as we establish, when you are leveraged 35-to-1 and you are funding 30-year mortgages with overnight money, your entire existence depends 100% on the daily confidence of the market. If your repo lenders look at your balance sheet, see billions in declining subprime CDOs, get spooked by rumors, and decide they do not want to roll over your loan for just one more night, you are instantly dead.
Exactly. This is the core tragedy of the liquidity crisis. Solvency measured over a timeline of years becomes totally irrelevant if lenders refuse to roll over your debt for just one night. Your assets might theoretically be worth something if you could hold them to maturity. But if you cannot secure the cash to fund your operations tomorrow morning, you are bankrupt by noon. When market confidence is your only real collateral, the very second it is stripped away, the firm dies.
And that brings us to the climax of this autopsy, the run on the bank. We are going to trace the timeline meticulously from March 10 to March 16, 2008. This is where the death spiral accelerates to terminal velocity.
We begin on Monday, March 10. The markets open with Bear Stearns holding approximately $18 billion in a liquidity pool. Internally, management believes they have a sufficient cash cushion to weather standard market fluctuations. However, rumors are swirling aggressively through the market that Bear is facing a cash crunch and struggling to secure funding.
And in the financial sector, a rumor about a lack of liquidity is entirely self-validating. It's a self-fulfilling prophecy. If counterparties merely believe you are running out of cash, they will pull their funds to protect themselves, thereby causing the exact liquidity crisis they feared.
That is precisely what happened. On Tuesday, March 11, the Federal Reserve, sensing the tightening credit markets, announces a $50 billion lending facility to try and inject broad liquidity into the system. But on that exact same day, Moody's downgrades Bear Stearns mortgage-backed securities to junk status, a BC rating.
A fatal combination of events.
Yes, this combined signal government panic and official downgrades triggers a full-blown institutional bank run on Bear Stearns.
And the run happens on two distinct fronts simultaneously. First, the hedge fund clients in that massive global clearing services segment, the prime brokerage clients, begin frantically pulling their cash balances and demanding their assets be moved to other firms.
And second, the wholesale repo lenders, the money market funds, that Bear relied upon for that $50 billion to $70 billion in overnight survival funding revolt. They demand massive increases in collateral haircuts, or they simply refuse to roll their loans at any price. The funding simply evaporates.
Wednesday, March 12. CEO Alan Schwartz goes on CNBC television in a desperate attempt to project calm. He assures the viewers and the market that the firm has ample liquidity and that their balance sheet has not materially weakened. But the market does not believe him. The stock drops further, closing at $61.58.
By Thursday, March 13, the bleeding becomes terminal. The $18 billion in liquidity they held on Monday morning has collapsed to a fatal $2 billion. They literally cannot fund their operations for another day. They are facing imminent, disorderly default.
Thursday evening, Alan Schwartz makes a frantic phone call to Jamie Dimon, the CEO of JP Morgan Chase. Schwartz is requesting a $30 billion emergency credit line just to survive the next morning's opening bell. Diamond refuses. JP Morgan will not take on that level of exposure to Bear Stearns' toxic balance sheet without explicit legal backing from the United States government. Bear Stearns is forced to notify the Federal Reserve that they cannot find a source of financing in the private sector and will be forced to file for bankruptcy the next day.
The Federal Reserve and the Treasury Department are forced to evaluate the systemic threat. They recognize that a sudden, disorderly bankruptcy of Bear Stearns, which is deeply interconnected with every major financial institution globally through trillions of dollars in derivative contracts, could trigger a cascading collapse of the entire financial system.
Therefore, on Friday, March 14, emergency action is taken.
The Federal Reserve Bank of New York invokes emergency depression-era powers under Section 13(3) of the Federal Reserve Act to provide a 28-day, $12.9 billion secured credit line to Bear Stearns. However, because the Fed cannot lend directly to a non-depository broker-dealer under standard protocols at that time, the loan must be routed through JP Morgan Chase, acting merely as a conduit.
But the emergency loan has the exact opposite of its intended effect. It doesn't restore confidence. It confirms the market's worst fears. If the Federal Reserve has to step in to keep your doors open for 28 days, your firm is fundamentally broken. Despite the $12.9 billion lifeline, Bear Stearns' stock crashes 47% that Friday, closing at $30.85.
The Federal Reserve quickly realizes the 28-day facility is entirely insufficient. The market will simply resume the run on Monday morning, draining the emergency funds instantly. Therefore, the Fed orchestrates the first emergency weekend meeting of its kind in decades. Over the frantic weekend of March 15 and 16, they essentially force a fire sale acquisition of Bear Stearns to JP Morgan Chase.
But Jamie Dimon refuses to buy Bear Stearns if he has to absorb their most toxic, illiquid mortgage assets onto his own balance sheet. He will not risk JP Morgan. To facilitate the deal, the Federal Reserve creates an unprecedented, highly controversial bailout structure.
The structure is a limited liability company named Maiden Lane LLC. The Federal Reserve Bank of New York agrees to purchase $30 billion of Bear Stearns' most toxic illiquid assets, effectively removing them from the balance sheet to make the firm palatable to JP Morgan.
And how is Maiden Lane funded?
This purchase is funded by a $29 billion loan from the Federal Reserve and a $1.1 billion subordinated loan from JP Morgan Chase. The structure explicitly dictates that JP Morgan's $1.1 billion will absorb any initial losses on those toxic assets before the taxpayer-funded Fed loan takes a hit.
With the toxic assets ring-fenced in Maiden Lane, the dramatic final conclusion arrives. On Sunday evening, March 16, 2008, the board of directors of Bear Stearns, effectively operating with a gun to their heads from federal regulators, agrees to sell the 85-year-old firm to JP Morgan Chase for a humiliating $2 per share.
It should be noted that the price was later renegotiated to $10 per share just a few days later to secure shareholder approval and stave off massive litigation. But the fundamental destruction of wealth was absolute, regardless of the revision.
A firm that was valued at $171.51 per share, with a market capitalization of over $20 billion just 14 months earlier, had been entirely wiped out. The equity of the employees, the shareholders, and the management was effectively vaporized over a single weekend.
And that brings us to the synthesis of our investigation. The death of Bear Stearns was not a slow decay. It was a sudden, catastrophic mechanical failure of a massively over-leveraged machine. They built an architecture of extreme leverage operating at ratios of 35-to-1 or higher, and they fueled that machine with highly illiquid, toxic, subprime mortgage assets hidden inside AAA-rated CDOs.
But most fatally, they ran that entire combustion engine on the highly volatile fuel of overnight confidence in the repo market. It was a mathematically flawless machine right up until the exact moment housing prices stopped going up. The moment the underlying cash flows cracked, the rating agencies downgraded the debt, the repo lenders demanded their cash, and the entire structure collapsed upon itself with terrifying speed.
The relevance to you, the listener, and to the modern financial system is profound. The Bear Stearns autopsy serves as a stark, permanent reminder that extreme leverage, combined with the illusion of safety provided by flawed credit rating models, can mask deep systemic rot for years. The balance sheet can look highly profitable, the SEC filings can show record earnings, right up until the exact moment the market stops trusting the mathematical models and demands actual physical cash. Liquidity is a psychological construct as much as a financial one.
Which leaves us with a haunting question to mull over as we conclude this deep dive. In the wake of Bear Stearns and the broader 2008 crisis, Regulators implemented sweeping reforms. Regulations like the Dodd-Frank Act and the Basel III framework forced traditional depository banks to hold significantly more high-quality capital and drastically reduce their leverage ratios. But if the core human instinct, the fundamental drive to chase higher yields through complex, highly leveraged mathematical models, has not changed, have we actually eliminated the risk of another 72-hour collapse? Or have we simply pushed that exact same systemic risk out of the highly regulated traditional banks and deep into the shadows of the unregulated, opaque corners of the private financial sector?